preparing to live stream, being live streamed. Okay. Setting up your meeting for YouTube Live. Meeting is now streaming live. Okay, there we go. And I see something slightly odd over there. No idea. It still says private. So I don't think anybody can see it. I'm not quite sure why it's doing that. But anyway, let's get started anyway. Hello, I am Adam Gower, and I am founder of gowercrowd.com and host of the Real Estate Reality Show at youtube.com/gowercrowd and actually on good podcasts everywhere. Are there any bad podcasts? I don't know, but all podcast channels that I can find. Welcome this to our weekly news roundup with my guest, Dave Sachs of Calvera Partners, who last week, unfortunately, I managed to call Dave Calvera of Sachs Partners. Do forgive me for doing that. That's what happens when you try and multitask too much. But anyway, Dave Sachs, Calvera Partners. And what we do every week is Dave and I are looking at kind of the main news headlines in the commercial real estate and syndication world. And we are looking at some of those stories today. And the ones that we're going to talk about today are that we've been seeing increasing talk of the impact of rate hikes on, dare I say, multifamily. Number two, more consolidation from the world of real estate crowdfunding platforms. And number three, banks are slowly but surely increasing their charge-offs. So those are the three topics. If you want to know more about Dave, or you want to know more about real estate syndication and crowdfunding, just go to the podcast page for today's episode at gowercrowd.com. While you're there, be sure to subscribe to our newsletter. It comes out every Wednesday. It has all these news topics and all kinds of educational materials, totally free. Go ahead there at gowercrowd.com. And at the bottom of the page, of course, for today's episode, you'll find links to Dave and to Calvera Properties. You can learn more about him there. Dave, nice to see you. It's coming to the end of the week this week. Let's start at the top here. Lots of talk about the impacts of rates on multifamily. And actually, what I thought we might do this week, I'm going to read some of these, just small quotes from these articles. BizNow came out with an article, multifamily market approaches, you ready for this? Hydrogen bomb scenario as CMBS loans come due. And this is what it is. I'm going to quote here, and then I'm going to go ahead and ping him in LinkedIn, see if he wants to comment as well. Despite high occupancy rent growth, some are warning of an incoming red October. So here we are in August for owners of multifamily properties due to the nature of financing for the asset class. Here we've got a nice quote here. Multifamily landlords face a hydrogen bomb scenario, according to Peter Sotoloff, a former managing partner, MAC Real Estate Credit Strategies, and former head of U.S. originations at the Blackstone Group. That is a credible guy.
Yep.
Hydrogen bomb scenario for multifamily. Dave, what do you think?
So we are seeing a lot of distress in the market. All we do is multifamily. We've been waiting for this to happen because it creates some good buying opportunities. We've touched on this in other episodes. You know, I would say there was a lot of things going on here, but there was some free, easy money over the last number of years, both for mostly real estate value add guys, real estate acquisitions guys in the multifamily space, but also for development. So if you had floating rate loans that are now skyrocketing, you're probably in a little bit of trouble. If you have expiring loans that you need to refinance, and we talked about this last week with homes, your interest rate's going to go way up, which completely turns your cash flow upside down, your capitalization upside down. You may not even be able to refinance out your loan amount, forcing you to sell at a bad time. So we are absolutely seeing this. You hear mostly about office, but now you're hearing about it in multifamily, where there's just a lot of volume that got done over the last number of years. And we've talked about that in previous episodes.
Yes, and sorry, I've been fidgeting with my other screen here because we are trying to go live, and apparently we are actually successfully going live today.
Great.
Right, so you're absolutely right, and in fact, there was another article that came out that was probably one of the best written that I've read. It's a lengthy article. I've got a whole bunch of quotes here. I shouldn't go through them all, but it's actually written by Sean Burton, who is founder and CEO of CityView. Together with, I must give him credit as well, Ryan Graff, who is one of their capital raising associates there at CityView. And I spoke to Sean for the podcast, actually, yesterday, to go out a week on Tuesday. So you definitely want to be listening to that. Sean is the founder and CEO of CityView. They're major, as far as I can tell, major multifamily institutional player, been around for a long time, been through the cycles. They know what the story is. And he made some very interesting observations. He said, this is one of the things. I'm just going to quote from this article. It's a very interesting quote. It's a superb article. Across the multifamily space, investors moved into riskier markets. And I'll add my comments in here as well. Of course, chasing yield, right? As they started coming down everywhere, everyone suddenly discovered secondary and tertiary markets. So they moved into riskier markets, riskier strategies and capital structures to increase returns and to compete for deals. And I guess that what also motivated that is this sudden access to equity through online syndications. If you can get money online, you gotta have deals, right? So a lot of syndicators have been looking to markets and persuading themselves that they have the same risk profiles as high density, high employment based, well-established major markets, when in fact they do not. And this is what Sean and Ryan over there at CityView said. Firms were rewarded for volatile, highly leveraged strategies, but until recently were not negatively impacted for failing to hedge longer-term risks.
It was a fantastic article, by the way. I agree with you. There was just a good amount of technical expertise in there. There was a little math. I actually found it very, very compelling. So kudos to the authors of that article. I mean, it kind of just went to what I just said. I mean, people moved further and further out. I mean, you can start in Austin, but if you keep going further out and further out and further out, pick any metro, you're taking on more and more and more risk. Yes, the yield when you can borrow at a low rate is really high and it's attractive, but the music is ultimately going to stop in some of those markets. Rents might turn the other way, your loans are going to come due, and the math gets upside down. Can turn. Real estate is cycles. We've talked about this, and you're going to be more impacted by cycles the further out you go from a primary market. It's just
and you know, this is what we're seeing. You know, the could talk about what are the signals. Somebody asked me, what am I seeing today? And the signals are this is one of them, that some of these tertiary cities are the first ones that you're beginning to see deals going south. Of course, they're the big news stories, the ones in Houston, Apple's Way, and some others that have become, we talked about Tides and some of the others, right? These major cities, but we're also seeing a lot of defaults, a lot of tertiary markets, but beginning to stop distributions, syndicate stopping distributions, and moving towards capital calls as well. This is what this article also that Sean continued to say. Managers, and this is very interesting and important point, particularly actually as I think about it, this is a clear indicator of sponsors who don't have experience. So, that's not what he mentions here, but think about that. Managers who invested in riskier strategies or assets without sufficient mitigation measures didn't always seek higher returns for that additional risk. So what was happening, and his chart actually in the article shows primary city cap rates merging with secondary city cap rates. And the point that he's making there is if you can get a 4 cap, right, in LA, why shouldn't you get one in secondary city, Lubbock, Texas, or pick a place? I don't say anything bad about. That's the point, isn't it?
Yeah, absolutely. We saw cap rates fall as the money became free, for lack of a better term, very low interest rates. Cap rates kept falling in markets that you would never expect them to fall to. I mean, I've been in real estate now for 25 years or so. And you never would see the same cap rate in Los Angeles or New York or San Francisco, as in your case, just use Lubbock, Texas, or any tertiary market. It didn't make any sense. And you were seeing people outbid folks like us that would use reasonable assumptions in our pro forma by 20 to 25%, effectively financially engineering their returns. Again, cycles happen. Some of these markets will stick. Don't get me wrong. You're also seeing, one last point, is even markets like a Boise, for example, that were the hottest market in the country because a lot of folks moved there during the pandemic. I've noticed some of the recent data that's turning pretty quickly as well. So there's a lot of things going on here that are causing distress.
Well, that's what I'm getting at there, though. It's again, somebody asked me today. I've been on a lot of podcasts recently. Somebody asked me today, what do you look for? How does an investor, passive investor, distinguish between sponsors who have experience and those who don't? And let's just say, and one of the big challenges, of course, in the last 10 years is that you've got a lot of people who've entered the market who are exceptionally good at marketing, but have no clue really about commercial real estate, what the risks are exactly. So how does an investor distinguish between those? And it's identifying how they understand risk and look at the fundamentals of different kinds of markets. Exactly what we've been talking about: LA, San Francisco, New York, Chicago, some of these major markets, some of the markets in Texas, they're just fundamentally different than markets, these secondary markets, and you cannot compare them on cap rates. You
can't. And I think when looking at a sponsor, we're about to buy our first deal in the Dallas Fort Worth area. We spent a couple years, and that's a popular market that everyone knows is probably pretty good. But digging in and who are the players? What are the fundamentals? What does the historical data look like? Where were cap rates when things went poorly in another cycle? What are the drivers? And then on top of that, you've got to make sure that the assumptions, as I mentioned in the pro forma of any sponsor who's showing you a deal, is based somewhat in reality. And that if things turn, what kind of sensitivity analysis did they run on all these things? We could go on, and I believe we've talked about this in other episodes on how to look at a sponsor so you can compare not only different markets, but who's showing you the deals, and all of that matters so much.
Yeah, how much risk are they prepared to take, and how do they really understand it? The other thing that I've been seeing, actually, Dave, is anecdotally. So I'm hearing from, I actually wrote down here the note that I have. I'm going to read it anyway. I've written down those naughty people who have been taking percentages of raises from sponsors. We talked about this last week, to funnel capital to them. And this is what I'm hearing. I've been on podcasts and lots of smiling faces. And when we turn off the cameras, I ask, all right, well, you've got this great model, but first of all, were you taking a percentage of the money you were raising? Yes, they tell me quite unabashedly. Yes, we get a percentage. And then we send that to the sponsor. And how are the deals doing? Well, yes, distributions are stopping. And capital calls we're starting to see capital calls. And so I've asked them, so how do you what role have you been taking here in order to be able to take that 2% or whatever percent of the raise? Sometimes they just take a cash payment. Other times they sign co-GP positions. They go as co-GP, and that is just a recipe for disaster, because if those deals go bad, investors are going to pursue who? The GPs. And if you're a GP, you're on the hook. If you've signed on something, you're on the hook.
Yeah, absolutely. And I think we've been reading a little bit about this with some folks in Texas and other places where that seemed to have seem to have happened, and one other point on the fundraising is, I was actually wondering myself, and very impressed with the marketing machines, as you touched on earlier in this podcast. They were raising so much money from folks. And I was always wondering to myself, as someone that I'd say, and you do it above board, we follow all the rules. Yeah, it can get a little wishy-washy out there. And you just got to be careful, again, going back to sponsors, that your sponsor is following all of the rules of the regulatory agencies, because it's good when everything is going up. But as soon as things turn, oh my goodness, the lawsuits, you're going to have the SEC going after you. Who knows who's doing that? You just have to be really careful that your sponsor that you're investing with is not. You just don't want to get caught up in that.
That actually is a superb insight. A question for a sponsor. Are you taking capital from any groups to whom you are paying a fee for the amount being raised, including my capital? Because if the answer is yes, and there's some kind of explanation about why that's okay, that's not good. That's cutting corners, right? It's not good. It demonstrates a lack of integrity.
Right. What you will see, by the way, if a group, say, works with a large wealth management firm or RIA, what you will see is if that RIA brings you a bunch of their clients in, that RIA is vetting you for 6 months, if not longer. It's not atypical to give the RIA fee discounts for bringing you all that capital at the same time, but that's not what we're talking about here. That's something totally different, and it's important not to get those confused.
Absolutely right, because RIAs, broker-dealers, they are licensed to do that. That's a whole different thing altogether.
Correct.
Let's not be too super down on multifamily. Let's wrap up our discussion about that before we move on to the next topic. But there's this high interest rates are a double-edged sword for multifamily, because on the one hand, and by the way, I'm trying to make this sound like me, but this is back to CityView's article. I actually give credit.
Great article.
To Sean. High interest rates are a double-edged sword for multifamily, because while they place downward pressure on valuations, right? So values are coming down. They also boost demand by making it more difficult for renters to leave the renter pool to buy houses.
Yeah, like most things, they can have different effects. I'm an economics major. I mean, things can go one direction in one metric and one in the other. We've talked about that before. Absolutely. I have friends that have expiring loans. They got interest-only loans from First Republic at a very low percentage. So in that case, they are going to have to deal with that. But as we've talked about in previous episodes, if your interest rate is at 2.95%, and we're going to get a new mortgage if you sell your house at 6 to 7%, you're staying in your house, which means that there's less supply on the market, which means it's just supply and demand. So it's
supporting these high values. That's the point.
Absolutely.
So now you got to buy at these high values, but you're paying, what's pushing 8% instead of sub-3.
And that will boost more demand for renting as well. Because if it's really, really expensive to go buy a home, that can only help what's already a supply constrained asset class generally, with a lack of, mid-level workforce housing.
Exactly. All right, let's move on to the next topic, Dave. Number 2 topic, more consolidation in the crowdfunding platform world. All right. This was an article in The Real Deal, actually from an article based on an article from something called The Information, which I just discovered today. The Real Deal, Yield Street closes in on deal to buy Cadre. Now, Cadre, for those that don't know, is essentially a crowdfunding platform founded by Ryan Williams in partnership with Josh and Jared Kushner, our former president's son-in-law and his brother, I guess, or father. I don't know.
No, it's brother. Yeah.
So here, just reading this here, if Yield Street closes the deal on the acquisition, and the value is Cadre is expected to hover around $100 million in value. This figure is a sharp dip from the 2017 peak valuation of $800 million. So let me just read this last bit here, because this is interesting. There's a lot of stuff going on. Not exactly sure what's going on under the hood here. Hopes were high for Williams as he took apparently meeting after meeting, et cetera, et cetera. In 2017, Cadre predicted it was only a few years from being able to surpass 400 million in revenue annually. Investors last year learned that the company was set to rake in less than 30 million in annual revenue, failed to become profitable once again. So they position themselves as a kind of fintech company. How much do you know about Cadre?
Yeah, Cadre I'm pretty familiar with. I've talked to a lot of these groups. Cadre was really smart when they started, in that their angle was that in all the ads, and I saw many on social media, so I was clearly being targeted with whatever they were doing on Facebook. I saw a number of ads. They would say that they were backed by the Goldmans of the world and the Silicon Valley. It was a really good job of differentiating their investor base, or the folks they wanted to attract to their site, to really high-end people, is how I would explain it. And it was clear they were doing that with their ads. Again, there was a little bit of bad publicity at one point because of their affiliation with Trump. I think that was not helpful. One other point I'll make is that I think when they started, they were doing raises on behalf of sponsors, so similar to a CrowdStreet. But they have moved, as far as I can tell, because I've reached out to them even before this article, it looks like they were just doing and moved to their own raises, if that makes sense. So they weren't working with third-party sponsors anymore.
It's interesting. So I actually thought it was the other way around. I guess you and I love to opine about things we don't know absolutely certain.
Yeah, I know, but I've been on there, and that's what it seemed like they were doing. I will say that their deals also looked more institutional in nature, which was a good thing. And so I was impressed with that, for sure. They weren't just throwing any old deal on there. I can't speak to their revenue or anything like that. In fact, I reached out to, I think, their CEO the other day, not way before this, maybe it was a couple months ago, and didn't hear back. That was before I knew that they didn't seem like doing other raises for third-party sponsors anymore.
Interesting. So they're only doing, now they're only, so I actually got it the wrong way around.
Yeah.
But that's also because I actually found, perhaps it's because my business is building websites and helping people doing marketing. And when I went to their website, it confused me, right? So maybe the messaging wasn't quite right. And maybe that's why their sales are down to significantly less than a tenth of what they thought it would be. And now they're up for sale.
Yeah, no, I've been on their site. I get all their emails. And from what I can tell, they've been pitching specific funds. From their own funds, from what I can tell. And they definitely do not seem to target your non-accredited investors or anything like that. It's definitely just a higher end feeling to their branding, marketing, and messaging, going back ages now from because I was on the receiving end of their material.
The sense of exclusivity. Well, the reason that I put it on our list today was in the context of the crowdfunding industry and the platforms that have emerged over the last few years that are becoming fewer and fewer. In fact, now, as far as I can tell, there's only CrowdStreet, Equity Multiple, and Realty Mogul on the accredited investor side. And now Cadre look like they may become part of Yield Street. So, consolidation. We've had bankruptcies, right? With Realty
Shares.
Realty Shares was one of the first ones. Not really downturn related. Realty Shares. No, that was more how their capital gave up on the hope of a unicorn and pulled the plug. Really, that was a venture capitalist type of nature of their capital. So it makes me wonder, with as few major players as there are left in the market. Number one, are there going to be any more casualties? Are there going to be any more consolidations? And does this mean that there is an opening? He asked himself, pondering what to do next for a new generation of crowdfunding websites that comes out of this. I see you shaking your head, but that comes out of this stronger because, of the lessons learned during the downturn.
Well, you're the definite. I want to get your take because you're the foremost expert on this. But from my view, I think in previous episodes I've mentioned that I've talked to these guys going back a long time. So I always assumed there would be consolidation, and I was always fascinated to see how it would all shake itself out and why. So we've touched on previously on the venture capital backed issues for realty shares, where these companies, CrowdStreet included, are often funded by venture capital who need quick growth. And we've talked about why that leads to some bad decisions and pressure to grow really quickly. So I always thought that there'd be some shakeout from that. Then I'd spent a lot of time talking over the years to Realty Mogul and also to Real Crowd. And when I talked to Real Crowd, who I just believe was rolled up to, acquired, I don't have the technical term, with an RIA, they always had institutional deals on there that seemed pretty vetted that I liked, but they weren't scaling as fast as CrowdStreet. And that seemed like because they were not putting every deal on there. It was pretty heavily vetted deals and they didn't scale for whatever reason. So I do think that the consolidation was bound to happen. I don't know where it ends, and I don't think it's a terrible thing, but I'd love, your opinion on this.
Well, I look, years ago, right at the beginning of this, not cycle, but right at the beginning, kind of shortly after the birth of the industry, the real estate crowdfunding, of course, is a misnomer, but the online syndication business. I had a conversation with Mark Roderick, and we were talking of Mark Roderick, the attorney. He's the crowdfunding attorney. Actually, is well known for that and for having tracked the Jobs Act and made some interesting predictions. But he and I talked about this as well and said, it will be interesting when there's a downturn, what is likely to happen. And of course, there will be failures and there will be of platforms and consolidation. And that is absolutely exactly what we're seeing. But out of this downturn always comes new growth. Different
angles.
You have a whole new generation. Look, there's a whole new generation of investors, accredited passive investors who've never had exposure to commercial real estate, who've come into the market over the last few years, and who also will be learning, unfortunately, the hard way that real estate does have cycles. And so that doesn't, it shouldn't, it won't, shouldn't put people off from investing in real estate. It will just make them better real estate investors, more, what do you call it? Selective is the, go ahead, Dave.
More educated. They're also going to be more discerning. And
discerning, that was the word, yes.
Yeah, and they're going to be able to really look at it with a more careful eye. And yes, you're right. Some of the folks that are doing this are young. They've never seen a downturn. I mean, I started my company in 2010, and I think I've told you that until this latest downturn, I didn't ever have to write a quarterly newsletter saying that rents had gone down in the country. Like for, I don't even know how many straight years. That's just mind blowing because we know real estate has cycles. So until there is a downturn, only then are now things happening where people are like, oh, it doesn't just go up forever.
That's right. All right. Okay, so let's move on to banks increasing charge-offs. So this is an article in Globe Street. Banks increase their CRE, commercial real estate loan charge-offs. Quick quote here from that article. Banks, it was actually a very well-written article. Much appreciated. I'll tell you why. Banks, particularly regional ones, don't seem to be in the best of shape. Aside for the handful of closures earlier this year, Moody's cut credit ratings of a group of smaller and regional banks and put a number of bigger banks on review for a potential credit downgrade on Monday. So that was just a few days ago. The total was rating actions on 27 banks. I was gonna say, we've been all reading about the regional banks that did have heavy exposure to real estate. I mean, even here in First Republic, Silicon Valley Bank. I believe I read this morning, it's not one of the articles, that Fortress bought the debt backed by a lot of New York office buildings today from a lender. I mean, we're starting to see this. We've also talked about how governmental agencies were talking to the lenders to get them to try and spread this out or work with their sponsors to smooth out the issues from this rather than rip the Band-Aid off. I mean, there's all sorts of just
kind of insane stuff going on right now that seems to be changing on a daily basis. And it also depends on where these banks are located and where their exposure is to the real estate.
Exactly. And I actually, this is I see everything that's going on with banking and the way the regulators are treating the banks as I describe it as a slow motion train wreck. But it's very different from the global financial crisis, because the global financial crisis, banks had to market. We've talked about this before.
Yep.
And that really just caused a precipitous fall in commercial real estate values, because everything had to be reappraised, and then everything had to be written down, and banks failed and they had to sell assets, and there was a fire sale, and it happened very, very quickly. And that was because during the GFC, it was it was a true black swan event.
Yep.
Right? It happened, and there was a threat of systemic failure. It was very frightening for a while. I remember sitting in conversations with very well-educated, knowledgeable, seasoned guys talking about the possibility of tanks, right, rolling through cities in America. It was very frightening. This one is a managed downturn. The Fed is deliberately throttling back the pace, is deliberately increasing interest rates. It's managed, and regulators are throttling back the pace of the downturn by asking banks to extend. I think that this idea of pretending gives them a wrong impression. There's no pretending. This is a managed downturn. Extend, because what they want to see is a flattening of the downturn, a slow downturn rather than a precipitous one.
Yeah, before it was pretend and extend was the
pretend and extend. Oh, pretend and extend.
Yeah, pretend and extend was the term. But I think we've talked about before too that you're right. People know what's kind of coming. I think it's kind of a slow, in my mind, slow kind of train wreck or whatever you want to call it. But you are seeing. I mean, again, I've mentioned that I'm here in San Francisco, and there's already 2 office buildings on the same street here on Spear Street. One just got bought at a 40% discount. Another one might be going back to the lender. So yes, it's pretend and extend, but there are things going back to banks in markets that are heavily impacted, particularly here where I am.
And just to comment on my conversation with Sean again, Sean Burton there at CityView. They have been, what do you call it? There's nothing I'm not out of school here, because it's exactly what he talks about. You can listen to it in the podcast. But they are marshaling cash resources in significant amounts to move on these assets. So that, and so how do mortals like you and I do that?
Okay. Well, it's pretty fascinating here, particularly with all the distress. I'm not in office, although I did work at Equity Office back in the day, to see who's buying some of these office buildings. So there's a company called Presidio Bay that just bought, I believe it was 60 Spear Street in San Francisco for something like 40% of its peak value. And I took a look at kind of who that company is. They believe in the future of San Francisco. You have to have a long runway. You may not get the cash flow for a while from that building. And I think that's a former, maybe backed by some Google money. So it's folks that can take big bets, that are sitting on big cash, that can buy something all cash and can be patient. And I would make that bet if I had, $5 billion. I'd start picking off some of these and being patient. I believe there'll be a rebound. You just have to have some flexibility on when exactly that's going to happen.
Well, yes, and if there was something, if there were things that that we can do to prepare for the opportunities that inevitably are coming, the key word, and you hit it there, is patience. Got to be patient. And while you're being patient, this is definitely my strategy here at Gower Crowd. It's frustrating because you want to get in, you want to be buying. Dave Ellebrecht, I'll probably get his last name wrong, at Turnstone, was complaining that we've not bought anything for a year. It's driving. Professional sponsors are really frustrated at the lack of activity.
Hmm.
But while it is slow, it's a good time to make connections, develop your network, right, of people out there, stay in touch with them, and continually communicate. Because when things break, they break quickly, and people go to those that are top of mind. And that's how I think you get into the deal flow.
Absolutely. Yeah. And, even though you may not like the pricing on every deal, in the markets that we like, we're still valuing everything, talking to the brokers, seeing if there's a bid-ask spread, trying to get a sense of value, which is really complicated right now because things with rates just are moving way too fast. And I can even remember stories back from the GFC where my business partner was in a deal pipeline meeting at our former company before we started our own thing. And he had this brand new, what was called a see-through office building because it was vacant in downtown San Jose that I think he could buy for $100 a square foot. Maybe it was 200. I don't remember. And the founder of our former firm was, I'll pay zero. So it's when the catching a falling knife is the other term. It's when do you move yourself in and it's you never know.
Well, we will see in the coming months. Dave Sachs, thanks so much for joining me today. Let's wrap it up there. What did we just do? We went through 3 articles that we saw in the news. I'm going to go ahead and put those on the podcast page at gowercrowd.com. I'll also put them up on the YouTube channel here that still is not allowing me allowing anybody to leave comments. I thought I'd change that setting. I'll have to figure out how to do that. Obviously got it wrong, but I'll put in the links to the articles. You can read them for yourself. Go to gowercrowd.com. Be sure to subscribe. Find out more about Dave. I'll leave Dave Sachs here a link to his profile on LinkedIn and also to his company, Calvera Properties. And Dave, thanks for joining me again.
Thanks. It's been an interesting time here in the market for sure.
Yes, and have everyone, Dave, have a good weekend.
Thank you
so much. And we will all be well. We'll see you next week. For now, this is Adam Gower and I guess Dave Sachs signing off.